Supermicro computer delivered a highly mixed Q4 2026 print today. We saw a slight miss on the top line, but an absolute beat on the bottom line.
Yeah, quite a beat.
Right. So revenue came in at $11.12 billion, missing the street's consensus of $11.26 billion to $11.73 billion. But adjusted EPS came in at a staggering $1.70, which completely obliterates expectations of 92 cents.
And, then there's the guidance, which is really what moved the needle. Management issued a massive forward guide. Q1 2027 revenue is projected between $14.5 billion and $15.5 billion.
Which completely crushes that $12 billion estimate.
Oh, totally. And with an EPS of $1.01 to $1.10, plus full year 2027 revenue guidance is set at an eye-popping $65 billion to $72 billion. That is well above the $53 billion to $54.43 billion consensus.
Yeah, and the stock reaction was immediate. Shares surged 9% in after hours, trading, pushing right past $34 a share.
Unsurprising given those forward numbers.
Right. So for you, the retail investor listening to this deep dive, our mission today is really to unpack this stack of sources we have in front of us. We've got the Q4 earnings press release, preliminary business updates, and some very detailed analyst notes from Mizuho and Rosenblatt.
Lots of data to sort through, yeah.
Exactly. And the goal is to figure out if SMCI is, a deep value play in the AI infrastructure space right now, or if it's actually a value trap that's masking some serious execution risks.
Well, to figure that out, we really have to reconcile the core paradox of this earnings report.
The miss versus the beat.
Right, exactly. On one hand, you have that headline revenue miss. On the other, you've got this massive EPS beat. To understand how they drove so much profit on slightly fewer sales, we really have to look at the mechanics of their margins and their product mix.
Which brings us to arguably the single most critical metric in this entire report. Yeah. SMCI posted a 17.5% GAAP gross margin. And just to be clear for everyone, even when you strip out the one-time charges, the stock-based comp, the non-GAAP number still sits at 17.6%.
Which is a dramatic recovery.
It's insane. They posted a 9.9% margin just last quarter in Q3. And their own guidance for Q4, what they told us to expect, was down at 8.2% to 8.4%.
Yeah, a hardware manufacturer missing their own margin guidance to the upside by a factor of 2 is, it's highly anomalous.
Right.
You almost never see a company that builds heavy physical data center equipment just double their profitability profile sequentially in a 3-month window.
So what's the driver here? How are they pulling that off?
Well, this margin expansion is being driven by a rapid shift in what they're actually selling. It's a highly favorable customer and product mix. Specifically, it's the demand for direct-to-chip liquid cooling systems and what the industry is calling agentic AI compute servers.
Okay, let's unpack this a little bit for the listener, because I think people hear servers and they think of big metal racks with loud fans. Why is liquid cooling suddenly commanding such a huge premium?
It basically comes down to the sheer physics of the newest generation of silicon. Exactly, the heat. When you look at NVIDIA's newest chips, the thermal density has crossed this critical threshold. If you put 72 or 120 of these GPUs into a single server rack, it creates so much concentrated heat that traditional air cooling, like literally just pushing cold air through the chassis with massive fans, it just can no longer absorb and carry that heat away fast enough.
The chips would just overheat.
They would physically throttle, yeah, or melt. So liquid cooling isn't just an optional upgrade for data centers anymore. It is a structural requirement. Chilled water actually has to be piped directly to cold plates sitting right on top of the silicon.
Wow. And because SMCI is delivering those really complex integrated liquid cooling racks, they're essentially building the plumbing, the manifolds and the cooling infrastructure directly in with the compute.
Right. They aren't just selling a metal box anymore. They're selling a fully integrated high-margin piece of critical infrastructure. And that deep integration allows them to charge a premium.
Got it. And you mentioned a second piece to this margin expansion.
Yeah, the shift toward agentic AI compute servers. So early in the AI boom, companies were buying servers primarily to train large language models. But now we're sort of moving toward inference and autonomous AI agents.
Meaning models that don't just act as chatbots.
Exactly. These are models that receive a prompt, break it down into a multi-step plan, write code, search the web, and, execute tasks autonomously.
Which requires a fundamentally different hardware architecture, I'd imagine.
It does. Agentic workflows require massive, continuous memory bandwidth and specialized compute nodes that operate in tandem. So SMCI is packaging these specific, really complex architectures for enterprise clients, and that specialization further pads those gross margins.
Okay, I mean, I understand the mechanism behind the margin jump, but I have to push back a little bit here. Is this actually sustainable?
That's the big question.
Right, because is this just a one-time product mix fluke? Kind of think of it like an automaker, reporting a blowout quarter for profit margins. If you look under the hood and realize they just temporarily prioritized building and selling fully loaded luxury SUV trims to a wave of early adopters, you know that profitability won't last.
Right. Eventually, they run out of rich buyers.
Exactly. Eventually, they exhaust that specific buyer pool, and they have to return to selling the lower margin base models just to keep their volume up.
So are we just seeing SMCI briefly pad margins with these early adopters of liquid cooling before they revert to a lower margin mean?
Well, Wall Street is having that exact debate right now. But the analyst notes point to the forward demand to counter that whole SUV trim theory.
How so?
The numbers are just massive. SMCI secured over $60 billion in new orders in Q4 alone.
Wait, really? $60 billion in just one quarter?
Yeah, just Q4. The backlog is sitting at record levels.
Yeah.
Which tells us the revenue miss this quarter wasn't because customers suddenly stopped wanting these high-margin racks, right? The demand is still voracious.
Okay, then why the miss?
The revenue shortfall came down entirely to execution bottlenecks on SMCI's end.
The sources mentioned delayed shipments and component shortages.
Exactly. And delays in shell construction for new facilities. Think about it. When a customer orders a massive liquid-cooled AI cluster, SMCI often have to rely on the customer finishing the physical shell of their own data center to even accept the delivery.
Oh, so if the building isn't ready, the revenue can't be recognized.
Right. Or if a single critical component, like maybe a specific high-bandwidth memory module, is delayed in the supply chain, the entire multi-million-dollar rack just sits unfinished in a warehouse.
Which means the favorable product mix isn't a one-quarter fluke. The demand is quite literally locked in that $60 billion backlog.
Exactly. But the burden of proof is now heavily on management. I mean, they have to prove they can unclog those execution bottlenecks and actually convert those orders into recognized revenue, and do it without letting their operating costs spiral out of control. Because if they have $60 billion in demand, you'd think they should be generating incredible free cash flow.
They absolutely should. But they aren't. They are burning cash at a historic rate. And that really brings us to the bear case.
Yeah, let's pull up the cash flow statement because it paints a very different picture than the earnings per share. The trailing 12-month operating cash flow is a staggering negative $7.56 billion.
It's a massive hole.
And with negative $6.6 billion in Q3 alone, I mean, you rarely see cash incineration on that scale, even in the most aggressive, hypergrowth tech companies. If you have $60 billion in guaranteed orders, how are you operating multi-billion dollars in the red?
The answer lies in the really harsh realities of the working capital cycle when you're building AI hardware. I mean, this is one of the most capital-intensive businesses on the planet right now.
Because of the chips.
Right. SMCI cannot simply snap its fingers and manifest an AI rack. Long before they can ship a product and collect a check from a customer, they have to purchase billions of dollars worth of components. We are talking about buying NVIDIA GPUs that cost tens of thousands of dollars a piece and having to pay for them up front.
So they are effectively acting as the bank for their own supply chain.
Yeah.
Let's walk through the timeline of how that capital actually gets trapped.
Sure. So say SMCI gets an order today. Day one, they have to place orders for the GPUs, the networking switches, and the memory. And within 30 to 60 days, they have to pay those suppliers.
Cash out the door.
Exactly. But the assembly takes time. If they're waiting on one delayed component, like we discussed earlier, that $3 million rack just sits on the manufacturing floor. Day 90 passes. Day 120 passes.
Burning a hole in the balance sheet.
Right. And eventually, the rack is finished, shipped, and installed. But then they have to wait another 30 to 60 days for the enterprise customer to actually pay the invoice.
Wow. So you are looking at basically a 6-month window where billions of dollars are flowing out the door to suppliers before a single dollar of revenue flows back in.
Exactly. And here's the catch. As their order book grows faster, that working capital deficit expands exponentially.
Because they have to buy even more components up front to satisfy the growing backlog.
Right, which burns even more cash. So to keep the lights on and the supply chain moving, management had to go to the capital markets. In June, they executed a massive $7 billion equity and convertible debt raise.
Which, I mean, that successfully boosted their cash on hand to $7.52 billion by the end of the quarter, curing that immediate liquidity squeeze.
It did, yeah.
But it came at a steep cost to the very people listening to this deep dive. They diluted their existing shareholders in the process.
They did. Issuing all those new shares to raise that capital means every existing share now owns a slightly smaller piece of the company's future profits.
So what does this all mean for the retail shareholder? It looks to me like they're caught in a structural doom loop. If the company books another $60 billion in orders next quarter, won't they just have to go back to the well, dilute the stock again, and raise more cash to buy the next batch of chips?
That's the worry.
Right. How does an investor justify buying a stock if the reward for the company securing more business is further shareholder dilution?
Well, you're hitting on the absolute core of the valuation debate we're seeing across these analyst notes from Mizuho and Rosenblatt.
So what are the bulls saying?
The bullish perspective argues that raising capital to fund highly profitable, essentially guaranteed orders is the best possible use of equity. They believe that once SMCI scales its manufacturing and works through these initial shell construction and component bottlenecks, the cash flow cycle will violently turn positive.
Like the backlog will finally convert and the cash will just flood in.
Exactly. But the bears, particularly the analysts over at Mizuho, they are looking really closely at the pace of this expansion.
And what's their concern?
The bears point out that SMCI's business expansion is currently outpacing its cash conversion speed by a dangerously wide margin. If execution bottlenecks remain a persistent reality of the AI supply chain, if there is always a shortage of a new memory chip or a delay in data center permitting, then revenue recognition will constantly be pushed out into the future.
So the cash just stays indefinitely trapped in inventory.
Right. And under that scenario, further financing rounds and further dilution remain a highly probable risk for the retail investor.
And working capital isn't the only structural challenge weighing on the stock either. The sources highlight a really shifting competitive landscape that is starting to pressure SMCI's initial advantage.
Yeah, the competition is heating up.
Because for the last year, SMCI largely dominated because of their speed, right? They utilized this modular building block approach to server design. So when a new silicon architecture was announced, SMCI could reconfigure their modular blocks and get a server to market way faster than traditional competitors.
That time-to-market advantage was their primary moat. But the analyst notes detail how legacy hardware giants, specifically Dell and Hewlett-Packard Enterprise, are rapidly closing that gap. They have heavily retooled their own supply chains to compete in the AI server market.
But how exactly are legacy companies like Dell catching up so quickly? Is it just money?
It comes down to scale, money, and entrenched relationships. Dell and HPE possess massive enterprise sales forces. They already have their equipment sitting in thousands of corporate data centers globally.
So they already have their foot in the door.
Exactly. When a Fortune 500 company decides they need to build an internal AI cluster, their IT department already has Dell on speed dial. Furthermore, Dell and HPE just have much deeper pockets, and they have established financial services arms.
Oh, so they can finance the purchases for their clients.
Right. They can offer aggressive financing terms to customers. And crucial to our earlier point, they can finance their own working capital cycle without necessarily having to dilute their shareholders every few quarters just to buy components.
That's a huge structural advantage.
It is. They are fighting fiercely for market share right now, which means SMCI can no longer just rely on being first to market. They actually have to compete on scale, execution, and price.
Okay, so we have execution risks, fierce competition, and beyond all that, there's a persistent legal and governance overhang detailed in the sources too.
Yeah, that's another big variable.
We have ongoing federal probes regarding export control issues, alongside the recent departure of co-founder Wally Laya. Now, obviously, we aren't making any judgments on the merits of those federal probes. We're just reporting what's in the notes. But we do have to look at the mechanical effect they have on the stock price.
Well, Wall Street abhors uncertainty. Government scrutiny introduces a variable that financial models just cannot easily quantify. It can affect the approval of export licenses, complicate internal auditing controls, and honestly make suppliers or large enterprise customers hesitant to sign long-term contracts until the probes are fully resolved.
Yeah, that headline risk really acts as a persistent gravity well on the company's valuation multiple.
Absolutely.
So let's synthesize all of these competing data points, bring the bullish margins and the bearish cash flow realities together to deliver a final valuation verdict for the listener.
It's a highly conflicted narrative for
Right.
Fiscal.
We've got the bullish reality of exploding margins, a record $60 billion backlog, and forward guidance that blew the doors off consensus estimates. But we also have the bearish reality of multi-billion-dollar negative cash flows, shareholder dilution, closing competitors like Dell and HPE, and lingering governance clouds. How is the market currently pricing that tension?
Well, if you look at the raw multiples, SMCI appears incredibly cheap on paper. Currently, it's trading at roughly 14 to 15 times trailing earnings.
Which sounds low for AI.
It is. If you compare that to its primary tiers, Dell is trading around 34 times earnings, and HPE is sitting all the way up at 46 times.
Wow.
So you have a company in SMCI that is growing its top line at over 90% year over year, yet it's trading at less than half the multiple of legacy hardware players who are growing at a fraction of that rate.
A 14x multiple for nearly 100% top-line growth is a massive disconnect. I mean, you usually only see a multiple that compressed if the broader market believes the earnings are a mirage, or at least highly vulnerable.
And that's exactly it. The discount is entirely intentional. The market is accurately pricing in the tension we've been unpacking today. Investors are weighing the massive, undeniable tailwinds of AI infrastructure spending against the very real risks of execution bottlenecks, severe working capital deficits, future dilution, and of course those governance overhangs.
So it's basically a penalty box.
Pretty much. At 14 times earnings, the market is essentially sending a clear message to management. They're saying, look, we acknowledge the $60 billion backlog and we see the margin expansion, but we refuse to pay a premium multiple until you prove you can turn that backlog into actual free cash flow without diluting the shareholder base again.
It's the ultimate show-me story for the next 4 quarters. The burden of proof rests entirely on management's ability to execute on the basic plumbing of their supply chain.
Exactly. The demand is de-risked. Everyone wants the product. The execution is the entire ballgame now.
Which actually brings me to a final sort of provocative, forward-looking thought for you to chew on before we wrap up.
Yeah.
We've spent a lot of time analyzing the immediate risks, right? The cash flow, the competitors, the components.
Yeah.
But there's an emerging threat detailed in the peripheral data of our sources that looks a few years down the road. Right now, SMCI's margin explosion is heavily reliant on packaging AI infrastructure and mastering the complex liquid cooling required by third-party chips like NVIDIA's.
Right. They are the middleman adding value.
Exactly. But what happens to traditional server vendors in the future if the massive cloud providers and hyperscalers, the Amazons, the Googles, the Microsofts of the world, decide to design and manufacture their own custom hardware, silicon, and cooling racks at scale?
Ah, yeah. It's the classic innovator's dilemma applied directly to the AI hardware stack. As the hyperscalers seek to lower their own massive capital expenditures, vertical integration becomes highly attractive.
If Amazon or Google bring that integration entirely in-house, designing the chips and building the racks themselves, they could effectively cut traditional vendors like SMCI entirely out of the loop for the largest deployments in the world. It's a structural, existential risk to keep a very close eye on as this AI supercycle matures from the build-out phase to the optimization phase.
It would change the entire total addressable market calculation, frankly.
Definitely something to watch.
Yeah.
Well, if you want to stay ahead of how this cycle plays out and see if SMCI can actually convert that massive backlog into actual cash, make sure you follow the show for our daily earnings coverage and deep dives. We will continue tracking the execution of these AI infrastructure players quarter by quarter. Thanks for listening, and we will see you on the next deep dive.